Good afternoon, everyone. Thanks for joining us today. We have an update with Akiba Leisman, CEO of Mako Mining. Mako trades on the tsx-v under the ticker MKO and under the OTCQX under Makoff. For those who aren't familiar with the story, I think we will do a bit of an overview, but it'll be mostly an update on recent results and kind of what's going on with the company. It's been about 6 months, I think, since we had an update from Akiba. I think it was August, right?
Okay, I'll take your word for that.
When I was looking to do my research, I think that was the last one that we had. Anyway, as always, this presentation will contain forward-looking statements. If you'd like to know more about those, you can check them out on the company's presentation on the website, which was recently updated. So feel free to check that out. And as always, there will be a Q&A section. So feel free to input your questions in the Q&A box at the bottom. With that out of the way, I'd like to introduce Akiba Leisman properly this time.
All right. Thanks a lot, Deb.
Yeah, thanks for joining us.
Yeah, no, it's always great to talk about what we're doing over at Mako, see where we are, kind of where we're going. I think for those that have followed the story, I think it's kind of important to take a step back from where we started, right? So Mako was created through a merger of two companies back at the end of 2018. It was a completely dysfunctional board. It did not have technical information that was up to snuff in order to go and develop a mining asset in Nicaragua, which has its challenges as an operating jurisdiction and some very good advantages as well from a country perspective. Over the course of the year after 2018, the board was restructured. The management team was restructured. I took over initially as interim CEO in March of 2019 and then full-time CEO in August. And then the controlling shareholder put in a slug of equity capital that year to get the mine started. And really, that initial project to get San Albino up and running was always going to be a stepping stone to get where we are today. In fact, we just reported a record operating results for Q4. We actually blew it out of the water in terms of what the mine was actually doing, basically doing everything that we thought, albeit it was probably a year and a half later than what our original underwriting schedule was when we first took control of this company back in 2019. So right now we're at a point where the plan, to quote the A team, is finally coming together over here. So step number one was to get this high-grade mine up and running. And for those that don't know, we have a particularly high-grade ore body. The vein within San Albino averages on an undiluted basis somewhere in the neighborhood of about 16 to 18 grams. There is a lower grade hanging wall and footwall on either side of that. And then inherently, we're mining this as an open pit. There's going to be some mining dilution. So from a head grade perspective, when you net everything out in terms of what's actually going to the mill, probably going to get an average of about 7 or 8 grams a ton. And we initially scoped this project out to be operating at 500 tons per day. So at our expected metallurgical recoveries, if you're sending, let's call it 7.5 grams to the mill and you're recovering 86%, and you're running this at 500 tons per day, that's going to get you a high 30,000 ounce a year run rate mine. And this is the issue that I think kind of plays with people's heads a little bit with Mako, is that when you say that you're going to be a 35 to 40,000 ounce a year producer, you're going to have two types of investors, neither of which is actually the appropriate response. There's going to be one where they're just going to ignore you, is that in their estimation, you need to have a particular heuristic, a check the box, if you will, to be an investable mining company, whether that's 100,000 ounces a year, 200,000 ounces a year, whatever the case may be. If you are not of that scale, you are not deemed to be institutional quality, and therefore we will not be making investments in you. So that's one type of investor. And then there's another type of investor is that, all right, I've seen this playbook before. I've seen these small scale bootstrap type operations. I think it makes a lot of sense on paper, and I really hope for your success, but I've never seen this work before. And I can count on my hands, my feet, and then some other appendages about all of the times that small scale bootstrapped operations just didn't work, right? So everybody wanted to get to this point where you're deemed to be a producer, but then where's the cash? How are you going to be using that to go and develop the next stage of the growth platform, which is either organic growth or external growth? So usually what happens in situations like that is that you have mining companies that get into production and they say, look at me, I'm a producer, I'm a producer, I'm a producer, get their investors excited. And then the successful ones wind up pivoting and buying something else, pivoting and trying to move on to the next story because the fundamental project that they built on a bootstrapped basis just did not work from an economic perspective. What we have at San Albino is an outlier in the industry, is that this actually happens to be an ore body that is particularly well suited to bootstrap development. We have a very shallow ore body. It starts 2 or 3 meters from surface. It allows us to develop a series of open pit mines. I mean, to date, over at San Albino, we've been mining 3 pits from that area. We have a new area called Las Conchitas, about 1.5 kilometers to the south, where we've mined to date 3 separate mining pits, but eventually it's going to be 7 when all is said and done. So just in a small postage stamp in our property, we have 10 separate mining pits across a very small part of our 188 square kilometer land package. And then over time, we can go and find more and more of these deposits. But here's the punchline. When we put out our numbers, our operating numbers, and we'll put out our financial numbers in April for Q4, we wound up selling for the quarter just under 13,500 ounces. Now, albeit some of that was catch up from a piece of inventory that we had in Q3. But at that 13,500 run rate, we were able to repay US $7.1 million of debt. We were able to reduce our payable balance by US $4 million. We were able to invest in exploration. We were able to pay taxes and royalties of US $5 million. We were able to increase our cash balance. We were able to execute on a pretty aggressive normal course issuer bid to buy back our stock, all on the basis of 1 quarter of production for what a normal mining investor would consider a subscale operation. So what we have over at San Albino is the ability to really have one of the holy grails for these bootstrapped operations, which is a mine that is particularly well suited to actually do the bootstrap, the thing that really is attractive for the people that are very concerned about prudent capital management in an industry that is not very well known for prudent capital management. Now, where we sit today, where our balance sheet is now pristine, where our operations are working better than they ever have, is now we have to look at how are we going to take the Mako platform, if you will, and then move it to the next stage of growth. And that's both internally and externally. Now, internally, we designed our plant intentionally to be able to expand to 1,000 tons a day. The primary limiting step on us making that decision, it's not permits. We are fully permitted to go up to 1,000 tons a day. It's developing enough a resource so we're not really caught on the hamster wheel of mine depletion at that kind of level. And that takes a lot of, not so much dollars, but it takes a lot of time and manpower. So a little bit about our exploration track record. So we, and this, and even taking a step back in terms of kind of where the balance sheet has gone as well, because it really does dovetail into what we're spending on exploration. The last time this company raised equity capital was in 2020, right? So we raised 2 tranches of equity capital to go and build the mine. And then after the mine got developed, really everything has been funded directly from operating cash flow ever since the mine turned on in July of 2021. And that includes repaying debt. It includes obviously paying everybody's salary. It includes mining our fleet for our mining contractor as well. It also includes a very aggressive exploration program. Since that time in 2021, we've probably put in over 100,000 meters of core drilling. We've probably spent in excess of US $24 million over the course of the last 3.5 years on exploration capital. But we have an ore body that really does take a lot of drilling for you to prove out a large scale resource. So going back to 2022, the mine turned on, we were generating cash, and then there was a couple of things that kind of hit the company that we needed to self-correct after that. So number one, we were having a few metallurgical challenges that took about 5 or 6 months to resolve, and now the mine is actually working, and the plant is working great with respect to that. And then in October of 2022, the U.S. government put a third tranche of sanctions on the Nicaraguan gold mining industry, U.S. persons operating in there. And then that did kind of change the nature of our cost of capital and kind of our thought process in terms of what the appropriate amount of exploration expenditure going to the ground was at that time. Now, to put that in perspective, at the end of 2022, we were exploring at approximately a $3.9 million a quarter run rate. So this was something that was approaching close to a little over US $15 million a year, almost exclusively core drilling. And that was going to be enough of an exploration program that if we did that continuously over the course of a few years, we would eventually get to the point where we were going to have enough resource to be mining this thing at 1,000 tons a day and be comfortable at that kind of level of depletion. Because frankly, our entire land package, our concessions are mineralized throughout. We have 28 kilometers of strike. The only thing that's preventing us from having a large scale mineable resource is drilling. It's time and also our human resources. So even at that level, we were probably using as much of our capacity in terms of personnel and our exploration infrastructure in place to get the maximum amount of data that we needed in order to develop that resource. So at the end of 2022, we kind of like down throttled a little bit on our exploration. We went from a run rate of about $15 million a year to last year. I think we only spent about $5 million in total on exploration, and then that is not a sufficient amount in order to develop a resource to mine at 1,000 tons a day. The second that the mine was working in Q4, that all changed. So the way that I like to describe it is that we went from a moment of playing defense in 2022 and up until Q3 2023 to a moment where now it's now really the gloves are off. So our exploration program, we run it more efficiently than we did before. We use reverse circulation drilling entirely instead of core. So we have the same amount of data coming out like we did in Q3 of 2022. But it's less dollars. I mean, our exploration budget is probably somewhere in the neighborhood of about $10 million for this calendar year, but it's getting the almost equivalent amount of information that we were getting at the tail end of 2022. And being able to explore at this level will eventually get to the point where the mine is capable of expanding from not even just the 500 tons a day. I mean, we've been mining pretty consistently at about 575 now, so about 12 or 15% above nameplate capacity. But making that choice to go to 1,000 for internal growth, just a matter of time. But it really does take time because exploration is really the rate limiting step for us being able to make that decision. And then secondly, now think about where we are in the market. No junior can raise capital unless they have an absolutely outlier special mine, one of those institutional quality projects that exist. And guess what, guys? There are 5,000 mining companies around the world. Maybe 25 of them are probably in that category. So the chances of an actual junior mining company being able to raise capital to advance their projects is not a probabilistic risk that rational investors would take at this point, which is another way of saying that this industry is kind of stuck. Now think about where we are. We now have debottlenecked this. So we started building this thing in 2019. We went through the pandemic. We got this commercialized in 2021. We've now cleansed the balance sheet. All the metallurgical issues are behind us. The geopolitical situation in Nicaragua, there's still risks associated with that, but at least it's now a known quantity. We are now in a situation where we don't need the capital markets to advance our project. Not only that, our platform is enough to unlock other people's projects, which are now stuck just because the junior mining market and the ability to advance projects of similar size and scope to ours is non-existent. So it gives us a fantastic opportunity to use the platform that we've developed in a very challenging environment over the course of the last 4 years to our advantage. And really, that's kind of like what Mako is going to look like really going forward for the next few years. Now, everything that I mentioned over there, you can see it in the stock price. So usually I kind of caution people that we're in a liquid stock. So stocks go up, stocks go down. A lot of it is noise. But sometimes you actually have like real information in stock charts like this. You can see that in 2022, we actually did have some challenges metallurgically as well as geopolitically at the tail end of the year. What I will make a distinction of is that the challenges that we had in 2023 were inherently different than what we had in 2022. So 2023 was off to a little bit of a slow start, right? So, and the reason for that was when sanctions were announced at the end of 2022, we took the approach of how do we really try to pull back on the amount of capital that's needed within Nicaragua until we actually know what was going to be happening from a geopolitical situation. And then all capital was really designated towards sustaining the business, number one. And then secondly, to make sure that the balance sheet was protected for a very uncertain time frame between, let's say, October of last year through the beginning of 2023. Now, we're very fortunate to have actually very good relations with the local and federal government and certainly the local population by our mine over in Nicaragua. We're able to have kind of forthright discussions with them about how the project was going to develop in 2023 and beyond. Now, we were advancing our second mine, Las Conchitas, which is a couple kilometers to the south over at San Albino. And the plan there was, all right, we're mining San Albino, fully permitted for that. And then we would be going and applying for our permit over at Las Conchitas. One of the things that we needed to do in order to get a permit, practically speaking, is to acquire all the surface rights that would ever be part of the project. And we were looking at the capital budget required for that. It was probably going to be somewhere in the neighborhood of about $3.5 million to do. And we're looking left, looking right, look at our balance sheet, which is always kind of run on a knife's edge a little bit, because we're very fortunate to have a very deep-pocketed investor as our controlling shareholder, so we can take some more risks that a normal mining company might find prudent. But that being said, we actually had a forthright discussion with the government and said, look, is it okay if we just acquire certain parcels of land and then only permit through a bulk sample in these particular zones, so these 6 or 7 mining areas within Las Conchitas? And they said, great, no, that makes sense. Like we'll be able to accelerate Las Conchitas. They were happy, we were happy. Now it turns out this was the first time that Nicaragua actually permitted a bulk sample over in the country. So it took a while for this to get approved, and it got approved probably about 4 months after we expected. So there was a pretty healthy contingent of mining feed that needed to come from Las Conchitas in order for us to maintain that 7 or 8 gram a ton head grade that we expect over at San Albino. And when those kind of 4 months of lack of overlap happened because of the permit delay, we didn't have access to the high grade from Las Conchitas. So effectively, in Q2 and Q3, we were mining at 5.5 gram material, and then that is kind of at a level which is effectively a little bit better than break even. It's probably enough to sustain the operations, but not much more than that. The second we got that permit, which was just an administrative delay, there was nothing, no real major risks of it not actually coming. But as soon as that permit came into place, we were able to mine Las Conchitas, and within 6 weeks, it made up the portion of our feed. So I tell people when you're looking at the chart in 2023, there was a moment in time where everybody knew what was happening, because I said it publicly on webinar. Deb said at the beginning, like our last webinar was in August. So after August, we actually knew we had the permit 2 months into it, and by that time, we were actually already starting to mine some of the high grade from Las Conchitas going through our plant. At that time in August, everybody that knew that this mine was going to hum, it did not show up in the stock price. And this is why I have to caution investors when you're dealing within a liquid company, is that sometimes stocks move for valid reasons. So I think that decline that you see in 2022 is very, very valid. And sometimes they move for reasons that have nothing to do with what's going on operationally. And this was a moment in time that happened back at the end of 2023, just to put some numbers around it. Those numbers that I quoted you, just for the quarter, again, 13,500 ounces of sales of gold that we had. And then if you added up everything that I mentioned, so $7.1 million of US dollars of debt repayment, $4 million of payable reduction, $1 million of cash increase, another $400,000 of an NCIB that we did, another $5 million US of taxes and royalties that we spent. If you add up all of these, if you wanted to get, like, obviously we kind of need a financial statement to give you a fully accurate level of EBITDA. But if you want to get like a good proxy of EBITDA, that's over US $16 million for the quarter. We were trading at that point in time where all of the information was known back at the time of our last webinar at a market cap of less than $60 million. Now, there are reasons why you can't really annualize the numbers of Q4, but if you did, just as like I got a metric, a back of the envelope calculation, we were trading at less than 1 times cash flow. It was really kind of an insane environment, which is the reason why we announced an NCIB. And as soon as we did, whatever residual shares that were trading in the market at those kind of prices, we just mopped up. Like it was effectively free money for us because there was really no reason for the stock to be trading at that level. And then last week, we kind of had like another weird thing happen with our stock price, is that we were in a stock index for odd reasons. We were in a silver index, even though we're not a silver company. That ETF that tracked the index owned 450,000 shares of Mako. And then because of a change in ownership of that ETF management company, from a company called ETFMG to a company called Amplify, those 450,000 shares went out on the market. So I get calls from shareholders, oh my God, your stock's down 20%. What's going on? What's going on? Is something happening over at the mine? The answer is no. The only thing that happened is that we had a forced seller of 450,000 shares that came in. We used 50,000 shares of that were repurchased through our NCIB. But when I tell shareholders that when you're dealing within a liquid stock, it's actually okay if the stock goes down for non-fundamental reasons. And it gives you an opportunity for liquidity. It gives you an opportunity to buy. And likewise, if for whatever reason there's a liquidity event when the stock goes up, like for instance, if an index buys it, I always recommend people that's probably a good time to take some risk off the table as well. Like understand what you're invested in when you're invested in a liquid company, is that sometimes the liquidity comes and you should take advantage of it when the liquidity comes, because you kind of have to do things when you can and not when you have to for companies like this. Now, this is a little bit of a different business model than, let's say, if you're going to be invested in somebody that's doing a property development and then eventually they get sold to the highest bidder over there, then great. You get all in one go. You can buy it, advance it, contribute more capital along the way, and then sell it in one fell swoop. I think it's great. I think there are people that do it wonderfully. Unfortunately, this is not really the asset that's perfectly suited for that type of business model. Now, I think at some point, Mako can be very saleable to other mining companies, but we do need to have a mix, a portfolio, diversified geopolitical situation as well before that happens. So I really do caution investors, make sure that when you're invested in a liquid company like this, is that you have the ability to respect that liquidity when it comes in either direction. And don't get excited when it spikes for unclear reasons, and don't get depressed when it falls for unclear reasons. But that is a very different statement than why the stock declined in 2022, which I think was relative to fundamentals. 2023 was nothing of the sort. So I'm going to just go over a couple of other metrics for this, and then I kind of want to spend most of the time just answering anybody's questions, because it actually has been a while. We're the highest grade open pit mine in the world. So we've now mined 3 open pits from San Albino. We started to mine 3 pits from Las Conchitas, but as I said earlier, that's going to go up to about 7 when all is said and done. Even with that This is a small postage stamp on our 188 square kilometer land package. I think over time, you're going to see dozens and dozens and dozens of open pit mines on our property. That being said, and really from the start of Mako, everybody always kind of like discounted that we have underground potential over here. This is an ore body where that 10.6 grams that we have in the measured and indicated category over here, that's a fully diluted number. So like I said, the actual vein over at San Albino averages about 16 to 18, and I don't really see any geostatistical differences more than normal statistical differences between what we have over at San Albino versus Las Conchitas. So we have an ore body that's like a half ounce undiluted. And then when you dilute it, either through our open pit mining approaches or through developing selective underground mining techniques, cut and fill, for example, you're going to wind up having diluted grades in the open pit or the underground that will approach kind of like what our effective head grades have been, 7, 8 in the case of Q4, 8.5 grams, or a measured and indicated diluted grade over here, 10.6. When all is said and done, this will work as an underground mine. Now, this becomes kind of a key aspect of what some of the internal growth is going to be coming from. This is an orogenic ore body. I think to make kind of a flippant statement, if you will, is that they say that orogenic mesothermal systems go down to the center of the earth. I think there's certainly some truth to that. Like our ore body has pinches and swells, and there's various levels of continuity associated with it. So it's not like you're going to have one continuous ore body going down kilometers and kilometers, but the actual structures that host these shears that actually host our deposit can run many, many kilometers when all is said and done. When we go after the open pit, we're really only taking the first 80 to 100 meters from surface from a vertical perspective. So that's probably somewhere in the neighborhood of about 200, 250 meters of dip based on the angle of our ore body. If you can actually prove that the underground is economic, and like I said, there's no reason why this underground can't be economic when you're talking about 10 plus grams when all is said and done, very shallow, like 100 meters from surface, is that you've instantaneously opened up your exploration upside by an order of magnitude. Whatever we have in the open pit, multiply that number by 10. Because now, I would say that it requires a lot of drilling to prove out. But in terms of what the actual potential is, there is no reason why these structures don't continue for many, many, many kilometers down dip, even though it's really only that first, let's say, 200 or so meters of dip, let's call it 80 to 100 meters from surface, that you're going to be extracting from an open pit mining technique. This year, we're getting serious about that underground. So we're doing our geotechnical drilling right now. To put this into perspective, in order to get like our first underground like portal developed into the actual underground infrastructure, it's going to take maybe 600 or 700 meters of lateral development, effectively going to this ore body maybe 40 meters from surface maximum in order to get to first production. This is a capital investment of $1.5 million, $2 million to develop a lateral development a program like that, in order to have access to ore that's going to be grading somewhere in these levels. It's a minor capital contribution, and in a very, very short period of time, that underground is going to help supplement the feed, not only coming in from this 575 ton per day mine, but it really takes a lot of pressure off for us finding more open pittable ounces elsewhere on our property. These numbers are all from the 12 months prior to Q4. So look at the head grades that I'm talking about, the 6.59. That does not include Q4. Q4, we had a blended head grade of somewhere in the neighborhood of about 8.4 grams. And that's why we were able to sell 13,500 ounces for the quarter. And again, it doesn't sound like a lot when you take, we recovered somewhere in the neighborhood of about 11,000 ounces for the quarter. But when you're operating at like 40,000 ounce throughput, it doesn't sound like exciting and big and relevant to the institutional, but think about how much cash we were able to develop. And it's not like some BS number where we're talking about operating cash flow of X, but all of a sudden you look at the balance sheet and it doesn't go anywhere because everything got spent for some sort of underground development or whatever. No, it was real cash that we used to repay debt, repay our payable balance down to levels that it hasn't been since we started. We were able to increase our cash balance. We were able to repurchase shares. We were able to do a lot of things with this cash that really sets the platform up for the growth that I was talking about earlier. And you can see exactly where this is going. And again, that mine operating cash flow does not include Q4. So you're effectively going to see that number go up just from one quarter by somewhere in the neighborhood of about 40% from this number. But you can see exactly what the mine is capable of doing. And again, we've not raised equity capital since July 2020. We had this very strange approach about how we got a lot of criticisms for how we were developing the mine. Oh my God, we raised money to build a mine and then used the cash flows from that mine to go and explore the property to find more. It's like crazy. It was crazy that we thought that way. But you know what? That was the plan. We were able to execute it on it. We were able to generate a lot of cash from our initial project. Q4 was really a blowout quarter in terms of what we were able to do, and really puts ourselves in a position right now where think about other juniors in our market cap snack bracket, our production snack bracket, and think about the situations that they're in. It's like I couldn't even envision running a mining company that size that needs the capital markets to go and advance where they are. It really would be a pretty treacherous environment to go and advance projects. Now, some of those projects shouldn't be advanced, but there are quite a few out there that really should. They're actually really good projects, really economic, but unfortunately, they're companies in this situation where they get stuck in the for very valid reasons, this dysfunctionality of the junior mining equity market. It's just like there's no capital available for companies like that. And we're in a very blessed situation where we don't need external capital. We can do the things that we want. We can run the business the way that we want. And people can criticize us for whatever, but at the end of the day, we were able to execute on our plan that we set out in 2019 once we took over management and the board of the company, and we were able to do this methodically. And now in 2024, I'm looking at Mako. It's exactly where I wanted it to be, albeit I probably wanted it to happen in 2022 and not 2024, but we're there. And I look at the environment right now, and it really is a target-rich environment for companies in our position, which really there aren't that many for companies our size. So, I mean, with that, I'll open up the floor to any questions, and glad to answer them.
All right, Akiba, first question. So at current rate of Mako's production, will Sailfish be able to continue its dividend at the current level?
Until so Sailfish has two streams of cash flow, right? So it's from the stream and royalty. So the stream that it has on the San Albino mine, which is still going to be in production really for the next 6 or 7 months. We're going to finish our third and final pit over at San Albino, and Sailfish is entitled to 3% effectively from that. And then everything over at Las Conchitas, which we started to mine, so it effectively is now a blended rate coming to Sailfish. They get 2% from a straight line royalty. So without getting like into too specific numbers, let's say for argument's sake, they're going to be getting effectively 2.5%. That is sufficient for Sailfish to run its business. It has been sufficient for it to carry the costs of a Mexican exploration asset that we're in the process of selling right now. And it is sufficient to pay for a small portion beyond that of the dividend. What buttresses the dividend is the remaining silver loan, which is the second source of funds that comes from Mako. There currently exists 15 more months of 13,500 ounces of silver going to Sailfish. And then that allows Sailfish to pay its US 5-cent dividend. And then there's probably remaining cash beyond that at these prices to repurchase another, let's call it 2 million shares a year, thereabouts. And that's kind of like the capital return policy. So at some point, and that point will either come in 15 months or gold can go up to $4,000 an ounce. But there will be a point 15 months from now where at that point in time, Sailfish actually does have an option to acquire all of the silver production coming from Mako, which is a small amount. It's probably about 3,500 ounces a month. So about 25% of what they're getting through that silver stream now. With that and the stream and the royalty, it's not going to be sufficient to pay the entirety of the dividend, right? So that's going to be a decision that will be made leading up to it. So it probably won't be 15 months from now. It'll probably be like a year from now. And really the way that we over at Sailfish, because I'm executive chairman of Sailfish as well, is kind of like our dividend policy is we give back all the capital that we can to shareholders, and that is sufficient to pay people to wait until you actually have information coming from Spring Valley, which is an asset that makes up the bulk of the NAV over at Sailfish. And then ideally, based on the schedule that we believe that's coming from NDEP and the BLM over in Nevada, is that we expect a record of decision on Spring Valley to occur before that 15-month window closes. So the long way of saying is that we have a clock based on our understanding about the assets and how that clock is going to be managed. That dividend will get paid until there's going to be a material positive, hopefully positive, permitting decision on Spring Valley. And at that point in time, we're going to have a lot more flexibility in terms of what we can do with Sailfish at that point in time. So people should be comfortable with the dividend for a year, and then beyond that, it really is going to be related to what happens with the permitting over at Spring Valley going forward, or potentially external opportunities over at Sailfish, which we're always looking for.
It seems like the cost of capital is extremely high in the junior mining space. What do you project Mako's return to be on incremental capital spent on exploration and expansion?
So a couple of things. Let me go over the let's call it the actual numbers and what we need and want from a return threshold and kind of how we think about the world. And then I'll go over some kind of interesting tidbits about what our balance sheet means for some, let's call it normie generalist approaches to measuring return on capital and things of the sort. So the first is, our primary business is to make sure that we have enough visibility to mine the way that we're mining in a reasonable scenario, so that we don't need to always scramble all the time. There was a lot of scrambling in 2021. There was a lot of scrambling in 2022. There was even more scrambling in 2023 for those odd permitting reasons. And it would be nice to not have to scramble as much. So the first order of business is actually not even a return on capital decision. It's like, we got to get our resource to a level where you can see the bags under my eyes, that we can actually sleep better at night. We're not there yet. That being said, I don't think, I mean, just to put this in perspective, is that our exploration that we've spent to date probably amounted to, let's call it on the growth side. So even beyond the infill side, probably on the growth side, we've probably spent, if you want to allocate directly to growth, somewhere in the neighborhood of about $7 or $8 million for growth exploration. And with that, we wound up increasing our net of depletion resource. So that really is growth, right? So not including everything that we mined in those 3 years, but just the net beyond that was about 100,000 ounces that we got, that we're very comfortable that we're going to be able to get out of the ground economically and profitably. And then of those 100,000 ounces, based on the profitability of the mine in Q4, or even like more normalized rates that we're going to be expecting, Going forward, you're still looking at over $1,000 margins on that. So pre-tax, so let's call it post-tax $700 margins as a number. So you could see kind of like the rate of return that you have on growth capital. Like you spend $7-8 million and you get something that's probably worth on an undiscounted basis 70 or 80. And these aren't coming out 10 years from now. These are coming out in the next 3. So it's really not going to be discounted all that much. So we really are looking at, even though it's not like the main reason why we're doing this because we have a business that we need to sustain. But you are looking at returns on exploration dollars that approach 10 to 1. So these are very, very attractive dollars that you want to spend. It's actually one of the reasons why I get a lot of questions about what our dividend policy is over at me. I get that, by the way, from the controlling shareholder too, from Wexford as well. But the first order of business is making sure that you have enough runway to run the mine. And I could tell this, full stop. You as a shareholder want us to spend that money on exploration rather than on dividends, for a whole host of reasons. If you're looking at this from the sustainability of the business standpoint, or even if you're looking at it on a purely mercenary, what kind of returns on capital are you taking a look at? Now, there is a limit to how much we can actually spend. Like we really are limited. This $10 million budget that we came with for this year, it wasn't limited based on targets and opportunities. It literally was limited is like, if we went 1 extra meter beyond this, is like we had to change the entire nature of the infrastructure that we had in place for how we were managing our exploration program. So the limiting factor was not money. The limiting factor was our capacity to run a drill program this big and get ahead of the data that was being created. If we were unlimited from an infrastructure perspective, the actual optimized exploration run rate would be substantially more than $10 million. Now, going back to the balance sheet, we have this weird artifact where we've depreciated and depleted our balance sheet to nothing, because the way that we approach the world, we're not looking to trick people. So our resource is what we want to mine. I mean, think about like how you optimize the mining company. It's like if your goal is not to mine this, if your goal is to sell it, well, how do you sell a mining operation? Well, you make up your resource. That's the first order of business, is put out bullshit numbers so somebody can actually acquire you on the basis of an inflated resource. And it's kind of like if you look at the technical results that not everybody, but a good beyond majority of our peers put out, these are not resources that you can build a mine around. So the first thing that we do is we try to put out resources that we know where they're going to get at. It's a complicated mine as part of our schedule. Now, in doing that, we give it to our accountants and say, all right, this is what we know. We're treating this as don't call the 43-101 place. We're treating this as our internal reserve. And this is what we're going to be depleting against on this. So the net effect is that we've effectively depleted our asset base on the basis of just forget about the resource of San Albino, but just on a portion of the open pit of just one postage stamp of our 188 square kilometer land package. So it effectively has depreciated our mineral property interest down to zero. I think it actually is going down to effectively zero at the end of this year. So that being said, if you actually look at the equity on our balance sheet, it's nothing. It's $10-15 million of equity. I think overall capital, you're probably looking on an average. It's probably, I have to remember what's on our balance sheet, but like $35 million of total capital. So if you're actually looking at this from actual brass tacks return on equity and return on capital, based on the numbers that we're going to be reporting in Q4, I would bet $5 to anybody on this line right now, and I could be wrong, but $5 to anybody on the line, that we're going to be reporting the highest attributable return on equity. Maybe it may not return on capital, but certainly return on equity in the entire industry. Now, part of that is real because we actually had an extremely profitable quarter for Q4. And then part of this is this kind of weird artifact about how we manage a conservative balance sheet. But I would for the normies and the generalists out there that are looking at mining, oh my God, looking at a mining company as an actual company, an actual stock, there are going to be some financial metrics that are going to wake people up when we put out our audited financials come April of this year.
Okay, a couple more questions for you, Akiba. So looking at the operational release from January, it looks like Q4 was exceptionally strong, especially looking at gold grades processed and recoveries. What drove these grades and recoveries? Is this sequencing of the San Albino deposit, or did the material from Las Conchitas impact the quarter?
So Las Conchitas was started to be mined in June, and I think it made its way to the plant initially at the end of July. So yes, I mean I think Q4 we're running high 30% Las Conchitas material. So actually, we had our one of our technical committees at the board yesterday. So one of the artifacts that come from this, in that we're not trying to reinvent the wheel with how we do our resource. What we are trying to do is try to get a handle on our ore body, and we have a particularly complicated like ore body in general, and there are different veins, and everywhere has got its own levels of continuity. And basically the punch we had, it was a 2-hour technical committee, but basically the punchline about our resource is when you're in it, you're in it, and when you're kind of on the margins of it, it's like it really does like break down pretty starkly. So when you're dealing with new startups, so when you're almost by definition, you're starting to mine at the margins of the resource. And then once you start developing the pit around it, you get into the meat. So anytime that you start with a new pit, a new area, a new deposit that we have, things can get like wonky in terms of reality versus kind of like what the modeling expectations are. And then when we're actually in the meat of the ore body, this is a heuristic that I really feel like viscerally, but I don't really. I think at some point I actually want to go through the data. But it's like when we're in the good part of the mine, it's better than expected, and when we're on the margins of the mine, it's usually worse than expected. And on average, that's actually good, right? So if you outperform by 10, let's say for argument's sake, 10% on the good stuff, and you underperform 10% on the bad stuff, on average, you're actually outperforming, right? So just because 10% of a big number is more than 10% of a small number. So where we were in Q4, it was kind of like a confluence of things that were coming into the mine, right? So we were in the meat of the final phase 3 of the West Pit. And then right now we're doing let's call it our northern and our southwest laybacks. Let's call it phase 4 for argument's sake. But we were in the meat of that zone over there. So we were in the meat of the ore body there. Over at Las Conchitas, we were mining 2 areas called San Pablo and Mina Francisco over there. So when those started in June and July, they were like, what is going on here? And by the way, like when we say at the beginning of the benches, like the first 3 meters from benches, like we're expecting 100 ounces, and we get and I'm using real kind of like directionally accurate quantity numbers. If we're expecting 100, we get 20. So the numbers are not like large in terms of the discrepancies. So we're expecting 100, we get 20 in the first bench. It's like, oh, God, what's going on? And you get one bench, so you go 4 meters deeper, and then you're expecting 1,000, and you wind up getting 1,800. So that's the type of mine that we have over here. So Q4, we had like these confluence of positive events. We're in the meat of the zone over at the West Pit, better than expected. We're at the meat of the zone over at San Pablo and Mina Francisco, better than expected. We had this kind of like weird inventory situation that got caught up in from Q3 to Q4. That was expected, but it actually just happened to show up in Q4 that winds up flattering the results a little bit. All better than expected. So we have this kind of like like everything is working in our favor. It's unusual to be running a mining company and everything's working in your favor. But that's kind of like what Q4 is. Now Q1, we have kind of like a different thing. So we're doing the northern and let's call it phase 4 laybacks of the west pit. So we're kind of like getting into it, and then finally we're in the meat of the northern with. Yes. So when we start, not great. When we're in there, better than expected. And then when we open up Bayakun, which is Las Conchitas south, it's the same thing. It's like we get in there, it's like, like our model is 3 meters to the south. And then all of a sudden, after 2 weeks, everything gets better than expected. So I think there's going to be some volatility, certainly in Q1, just because we're actually changing the areas that we're mining. And certainly you should not annualize the numbers that we had on Q4, because not only was everything kind of like working in our favor operationally, but we also had this kind of one-off thing coming from Q3 as well. That being said, even when we're kind of managing the business with these kind of like interim volatility issues, it's not even like grade variability. It's kind of like where we are in the model and the mine. And like I said, with the 2 hour, breaking it down to the punchline of this 2 hour technical meeting, when you're in it, you're in it. When you're on the margins, you're on the margins. And you just kind of have to manage the business with that. Luckily, starting in February, we're in it with everything that we're mining right now.
How long do you anticipate to be in it?
Well, it's going to be like this, like forever. So like every single open pit is going to have like a limited mine life, because some of it is going to be longer than others, right? So for instance, San Albino, if you saw go share the screen again, but you can see San Albino, the ore body is basically going straight down that hill. So you got topography in your favor over there that allows you to mine probably a good, wow, like maybe not quite 300 meters of dip on the San Albino vein. We had an ore body to the central pit, which is off to the behind that white patch that you see on the front of this presentation, called the central pit on the Aras vein. That went straight into the hill. So we effectively mined that for 6 months, maybe something like that. So it really depends on topography, and you'll see that. So we have areas over at Las Conchitas, like Mina Francisco, which was a fantastic, and it's going to be a fantastic underground, but it went straight into the hill. So I mean, there's like a limit to how much material you get in Mina Francisco. Bayakun and El Limon are different. We expect to be mining that open pit for years to come, and all of them, inclusive of what you see on the screen right now, all of them are going to have underground potential. But I would say this is not even. There's a lot of good things that come from operating a super high grade mine in a jurisdiction that's friendly to mining, and then there are like weaknesses with a deposit like this, and one of them is that you really are mining pods, if you will. So it's never going to be like you're on the vein and you're going to be there for. I just finished Deadwood on HBO. So you have like George Hurst got the Homestake mine in South Dakota, right? So he him and his predecessors found that in the 1870s when that take place, and it shut down in 1990, right? On basically one continuous vein. This is not that, right? So you're going to have like a series of pods, and then sometimes you're going to be in these cash gushing quarters, and then sometimes you're going to be in these like kind of keep it together quarters, and that's just the nature of the beast. Hopefully, when we actually have, from an internal perspective, enough resources ahead of us, we'll have more flexibility on how we plan this out. And likewise, when we're looking at this from an external perspective for M&A and projects, we're going to be looking at companies and mines and projects that supplement what we have, right? So that some of the weaknesses that we have for an ore body it's effectively mining hundreds, if not thousands, of these pods over the next decades, you'll have like a more traditional ore body that you can really do better long-term, more even keel, better sleeping type deposits. Went to the dentist last night. They said I grind my teeth. I can tell them exactly why I do that, right? It's because of this deposit right here.
Okay, well, I think you answered my mill feed splitting question without me even asking it, so I'm going to skip over that one. Let's see, in 2023, the San Albino mill has now been operating at 600 tons per day for almost a year. Now, to reach this throughput, have there been any changes to the design of the circuit, and what changes would need to be made to reach 1,000 tons per day?
There have been definitely a lot of optimizations on how the plant was handled. So we actually had a pretty good handle on what the metallurgical transition would be when we went from the oxide part of our ore body to the fresh material. But it kind of like whacked us up the side of the head at the beginning part of 2022. So when I went through the plant, and like I said, we were expecting it. There were 80 separate things that we needed to optimize. It was not any like one big thing. Or maybe there's a couple of big things, but a couple of big things and like 80 small things that went to the optimization of the plan. So really our objective is that we want to maximize the amount of material coming out of the gravity circuit. So we do have a second Nelson concentrator over at site. The functionality of that is really to make sure that there's no downtime on the gravity side. But it's both of them would be sufficient for 1,000 tons a day. We made some changes on how we do our detox work. We made some changes on kind of how we oxygenate the leach tanks. We've made certainly changes in the refinery. We had a pretty crisis level issue back in July when our doré had some contaminants in it that the refinery, third party refinery that we had some second thoughts about. So we had to make some changes on how we were managing the refinery as well, all to optimize what we have. Now, in order to go from where we are to 1,000 tons a day, it's actually very limited. So we do need to build another 5 leach tanks. That's hundreds of thousands of dollars, if that, to go and build the steel for that. Probably going to run out of capacity for our filter press for our filtered tailings. Our current one can probably run maybe like 750 tons a day pretty continuously. So we'll probably have to expand that a bit, maybe not have like the exact same size, but do that. And then to run 2 mills simultaneously, we'll have to have additional generator capacity. The government is talking about putting a power line pretty close to the project. I think like our back of the envelope calculation is that it's not that much to hook up, but I do think for the foreseeable future, we're going to be on gensets. So that will add some both capex and incremental opex, maybe not on a per ounce basis, but incremental opex to manage those as well. Our scoping out of expanding this to 1,000 tons a day, again, predicated on the fact that we have the resource in front of us, it's not going to be more than $4 million. So just as we had the civil works are done, everything is basically complete, and now it's just kind of like incrementally increasing the size of the plant, knowing that the first one went through a series of many different optimizations to handle the ore body that we have, and then metallurgically, I really haven't seen anything different on our property. I think if anything, Las Conchitas is slightly better than San Albino, but it's like same stuff. It's the same host rock, same carbon distribution, same level more or less of sulfides and things of the sort. So you're gonna wind up having very similar type material come through the mill for as far as the eye can see.
You touched on underground optionality. Is underground development something in your near-term plans? And what could an underground mine look like in terms of mining method and also metallurgy, if you've gotten that far?
Metallurgy will be the same. So we've been mining open pit, 100% fresh material with all the preg robbing characteristics that it has for a while. Now we blend that with other type of material before it goes into our mill, and then we're very careful on how we we measure the preg robbing characteristics and most importantly, mining it selectively from an open pit perspective. Then the underground, same rules apply, is that there's a whole host of reasons about why you want to mine underground selectively. Last time this had a PEA, again, albeit a bullshit one, was 2015. They were looking at this as a room and pillar approach, just because of the nature of the angle of the ore body. They thought that would be sufficient. This is not going to be, no way. This is a cut and fill mine. On occasion, you're going to probably have some geometries of the ore body where you might have like very, very small areas that you can do some less selective mining, like long hole. But I would say the bulk of it is going to be more than 60% of it. It's going to be cut and fill. In terms of the work that we need to do to get there, we started our geotechnical drilling. And then kind of like, just like the open pit, it's going to be similar, is that our underground mine is going to be going after high grade pods. Just as simple as that. I think you're going to find 80% of the ounces in the underground are contained within 50% of the tons that we have in the model. So we're likely going to be selectively mining, so that the 10.2, if anything, it's going to be a higher diluted grade from the underground when we're going to go after it. And the way that we're going to choose to go after it is that, all right, what's the lowest hanging fruit? So right now, the most well-drilled area, the one that we know the most about, and kind of like where we kind of see where the portal is going to go, it's kind of like we're mining on the west pit over at San Albino. So we're finishing off that phase 4, so that northerly layback that we have on the west pit right now. And then that's going to leave a lot of 20-gram material just sitting there. So like I said, the way that we're going to be going underground is that we're going to be developing the infrastructure in the footwall. We're going to be developing from down up and doing kind of like our underground infill drilling from down up. So even to get to the bottom of these pods in this ore body, you're talking about maybe a lateral distance of 50 meters. It's nothing, right? So, and then to actually do your vertical distance of about 50 meters, to do your lateral development on that for a standard cut and fill mine where the infrastructure is going to the footwall, it's going to be like 600-700 meters. It's nothing. So people need to, every time that you say underground, they're different like alarm bells that go off. They're the folks that actually look at our geology, and then very valid alarm bells is like, all right, you have these kind of like shallow dipping ore bodies, is that, you need a lot of support for this. Make sure that you do this correctly. Those are very valid technical reasons that we were like gonna spend the next few months kind of going over in detail about. And then they're like the kind of like crazy type stuff is like, oh my God, I once invested in this underground mine and it was like this money pit. They raised $100 million and it went bankrupt. See it time and time again. This is just not that kind of underground mine, right? This is like we're not like sinking a 500-meter shaft in the middle of northern Canada over here. It's like this is the ore body. I mean, we're really talking about something that really is sitting very close to surface right now, and the risks are really more on the latter, which is kind of like managing the OpEx risks, like getting dilution and grades, if you're mining this right. Obviously, safety concerns that go with that as well. Risks are not on like capital blowout situations. It's an inherently different risk profile than what most investors think about when they think about underground mining.
Got it. And then switching gears a little bit, so onto exploration. Now that Las Conchitas has a resource, what's the most advanced target on the property? And do you have plans to go there this year?
Yeah, so like Las Conchitas was not the most advanced like prospect when we beyond San Albino when we started, right? It was the El Golfo mine. Now the El Golfo mine, the surface rights are owned by one of our neighbors. They have a family that's like a telenovela. So sometimes we kind of like gingerly talk to them about doing some work and exploration work. I think over the years they've become more comfortable with us and vice versa. So we never got the entire reason why Las Conchitas is our second mine is that we never got around to like doing a deal with them to get the surface rights and then move forward. We are prospecting immediately to the south of where they are. So there's a few exposed tunnels over at we're calling it El Golfo Sur. So the like creative name over there. And lo and behold, it's like, oh my God, we got more super high grade 50, 100-gram hits on exposed tunnels. Literally just like we have everywhere else, right? We have it there, we have it at El Golfo, we have it at Las Conchitas, we have it at San Albino, we have it at Puerto Rico, we got 20, it's the same stuff, right? So the probably from going from target delineation to deposit delineation is a process. We're going to be taking a lot of the information that we learned about San Albino and saying, kind of like putting ourselves in kind of like a time machine, saying, if we knew what we knew now about how this deposit behaves, how would we go about San Albino and drill that out then, and probably use that to kind of like guide our exploration results. So there's going to be a lot of differences in how we kind of like do deposit delineation. So we have our targets, and then hopefully we'll be successful. But right now, this is not. If you think about how San Albino was developed as a resource, it was owned by one of our competitors back 2005 to 2008. They saw some underground workings and they tried to chase it. Every single hole missed, right? And because they were trying to line up kind of like some of these collapsed workings with where they thought the ore body was, and they were just drilling in the wrong direction. So what cracked the code is that we were actually able to find in a public library in Wyoming, in the United States of all places, the actual mine plans from the late 19th century to the early 20th century about the mine. And then once we actually had the actual mine plans, well, we drilled it. Right? So it's like it was all core, it was all direct. We kind of knew, it was before even I got involved. This is going back since 2009. So the main, like let's call it Golden Rain Mako discovery was really reading historical information and going after it. Obviously, we don't have that for elsewhere. So we're trying to see if we can develop drill programs using our RC rig, which is twice as fast, half as expensive to go and use our prospects and try to do a systematic exploration like program and hopefully make like real deposit discoveries through that approach.
And in terms of like truckability, like how far can you truck ore and make it still economic? Like at what point do you have to build a new facility? Because you've got quite a vast project, right?
A good proxy is Las Conchitas, right? So we were using effectively San Albino is like a waste moving exercise, right? So we have a 30-to-1 strip ratio. So it doesn't matter where that ton of ore is going. It really is like a waste, like it's 30 times more important about where the waste goes than where the ore goes, strictly from a hauling basis. So over at Las Conchitas, initially when we didn't have one of our more southern waste dumps permitted, we were going to have to truck to the northern one initially, right? So there's probably an extra kilometer of haul distance associated with that. And then that wound up adding 40 cents a ton, which may not sound like a lot, but if you apply that to all the waste and all the ore associated with it, it winds up being like $7 million a year. So it like kind of like puts it home. It's like maybe you want to like get those waste dumps closer to your deposit permitted quicker. Which luckily we did. So those were like top priority capital. And when we spoke about kind of like breaking up the capital for our property purchases, one of the top priorities was like buying this $150,000 piece of property, which is going to wind up saving us like $40 million a year forever, like for as long as the open pit mines exist. So those are like top priority capital investments. But then if you think about it from the other way, it's like that's $8 million for everything, right? Then you gotta like think about it, what 40 cents a ton on a ton that's grading 8 grams, so like a quarter of an ounce material. So you have $500 a ton, and let's say it's 20 kilometers away. We'll probably have like a better optimized fleet in terms of moving it. But 20, you're talking about an additional $8 a ton. So it's like you're, I don't know, like an extra $30-40 an ounce of haulage costs when you're talking about $8 a ton, but just for the ore. So if you find like in another deposit 20 kilometers away, we better damn well permit a waste dump by that area. But the ore is kind of like irrelevant in terms of the grades and the costs of what you're doing.
Okay.
So like everything, like if we had this kind of grade 500 miles away, it would be economic to truck.
Okay. And then going back to the underground, I had a clarifying question. The underground would seem to be better described as a series of adits. Is that correct?
Well, I mean, yeah, I mean, you're gonna have to mine on levels, but each one is like you're gonna have to fill this. It's gonna be small, selective, but yeah, you're gonna have to go in there and develop your infrastructure, not only looking at where you are on the ore body, but also how you're going to be filling the support as well. So it's selective. It will be slow. Each one of these pods is not going to be bringing out like an extra 500 tons a day. Each one of these pods is going to be like a supplementary 100, 200 tons a day to the mine plan. And it can be coming from multiple different locations and multiple different veins.
Got it. And in terms of low-hanging fruit, is optimization at San Albino / Las Conchitas a higher priority than M&A? If gold were to increase a lot in price during the next several months, the window for juniors to attract financing may open up again, so the opportunity might go away. How do you balance that?
We can only control what we have, right? So so if the opportunities go away, then so be it. Then we have this. But like I can walk and chew gum at the same time. So we have a business to run. We optimize that as best we can. And if there are opportunities that are there, we go after any one that makes sense. And our ability we have a very deep pocketed controlling shareholder. Now that doesn't mean we can, nor do we actually want to go after multi-billion-dollar projects. It's beyond our capacity or desire. But to the extent that there are small assets out there that kind of make sense for our team and our portfolio, we'd be glad to do that. And if the opportunities go away, we are experts at doing nothing when nothing makes sense. So I wouldn't worry about us like being forced to do something externally. And then optimization within our business happens every day.
And are you looking at M&A with companies that are only exploration focused or companies that are also in the production stage?
Like obviously the ideal situation is to buy a really profitable mine in a jurisdiction that we understand, where our people can optimize it and make it better, and to buy it really, really cheaply. Great. Like so we would love to purchase a unicorn in that regard. Those don't usually exist. If you look at the constraints that we have, so we have a small team, very capable team. there's a limit to how much we can manage across time zones, right? So we are focused, and our expertise really is in the Americas in general. So you kind of are looking at North and South America and Central America, obviously inclusive. And then in terms of operating under the assumption, so people like often ask us, so like, why are you invested in like a 30,000-40,000 ounce a year producers? It's like, first of all, it is usually those are the ones that have the best return on capital metrics. So number one, not always, but usually. And then two, kind of like we always have to operate in the assumption is that what if the financial markets didn't exist, right? So what exactly is within our capacity? And then if you look at how you optimize your portfolio in that regard, these are kinds of the types of assets that we gravitate to, and also kind of like what our team is designed around. Is like we're not SNC Lavalin or some like large scale conglomerate type engineering company. We have our own. We kind of like run this like really good private company type owners and engineers, high quality for assets that we can kind of control with our own team, and that basically kind of feeds you to these relatively smallish opportunities. That being said, the more we grow, the more our team, from a personnel perspective, grows. The more availability that we have from capital outside of the controlling shareholder, those opportunities and opportunity sets actually enlarge as well. It's so not everything about mining has to be like a vicious cycle. There are actually virtuous cycles that happen too, right? So, and then we think we're in a great position right now from where San Albino is to kind of like start that virtuous cycle, and things can really take off in pretty short order when that happens.
Sounds good to me, Akiba.
Nice.
But that's it for audience questions, and I don't have any of my own left. Was there anything you wanted to talk about today that we didn't cover?
Yeah, like markets suck, right? So like and I would just be cautious that a lot of the reason why the junior market is kind of like stuck in the place that it is, it's for its own fault, right? So it's the nature of the business, the nature of the risks. Management takes a lot of blame. I operate on both sides. I don't feel like I'm going on the other side to insult you. I think all investors take a lot of blame for this as well. In terms of how the industry is set up. And one of the very good things about Mako is that, and one of the good and actually very bad things about me, kind of annoys the hell out of a lot of people, is that I can kind of tune out what people say, and then we can kind of like focus on what we need to do. And I think we get our fair share of criticism from, not so much from the outside and the generalist community, because I think they kind of understand what we're doing, but specifically from the mining community in terms of what we do. So if you actually go back from 2019, there's certainly a lot of mistakes that you can point out, but I don't think there was actually any decision process that we did that wasn't rational, right? So that's not the same thing about outcomes. So like you can make a rational decision and then it doesn't go in your favor, and then something bad can happen because of that. It's not what I mean, but I mean like the actual rational decision processes that we had. I think we're valid in like how we kind of like got this project up and running, how we did it, how we financed it, how we like managed the business through some very difficult times. And I'm very fortunate to have like a really good subset of very loyal shareholders here. But I also noticed that there really aren't that many like institutions on the register either. So I think everybody kind of needs to take not because we don't want them. It's like we actually want Mako to be like a real public company and then have like the ability to grow into that. So I think there's a lot of soul searching that kind of needs to be done, where everybody kind of like bangs their head against the wall on some of these assets because they want it to fit into a box that doesn't exist anymore. Right? They want to be able to say, I want to invest in this asset. I wanted to advance it, go through step. I don't really want to mine it. I then want to sell it to somebody else. And that's great. That market doesn't exist. And when the end market doesn't exist and you're there basically trying to do things less in a rational sense, and you're really just trying to kind of like spin the plates on sticks to try to keep things moving along, you're going to get into trouble. And you're going to get into trouble as retail investors. You're going to get in trouble as management. You're going to get into trouble as institutional investors. I don't think they're off the hook on this at all. So the way that we looked at this business from the start has been rational. And I challenge anybody to say, all right, what specific like faulty decision process do we have from the start that got us into where we are right now? And then people should have an expectation that those rational choices are going to continue. And then, so how does that look like as we build the company, both from an internal growth perspective and an external one? I'm curious how it's going to look like, but I'm more confident about where Mako's position is today than I ever have been.
Okay, great. And then upcoming catalysts that the market can watch out for?
So our financial numbers are going to be coming out on probably the second week of April. So it's actually going to be a while. It's kind of weird that the venture exchange listed companies wind up publishing their audited yearly financials like 4 months after the year end. But I think most people are kind of like prepped in terms of what Q4 actually looks like. Hopefully we'll have some news on the M&A front. On the exploration side of things, we put out all our results from 2023, so it's going to take some time to have 2024 results kind of make its way through external labs. So I don't actually expect any, maybe at the end of February, but it's probably going to be early March for drill results to come out. And in the meantime, keep doing what we're doing, which is mining the highest grade open pit mine in the world in Nicaragua.
So, well, thanks for your time today, Akiba. And thanks to the audience for participating. If anyone has any follow-up questions or would like a one-on-one, feel free to reach out to either myself or Akiba. We can help get that arranged for you. And yeah, looking forward to seeing you again soon, Akiba.
All right, great. All right, thanks, then.
Thanks, everyone, for your time.